Hi class, this is the final video in our series of evaluating financial performance, and it's going to focus on liquidity, an incredibly important part of how we evaluate businesses and their financial performance. If you're using the Macmillan textbook, you'll find this information on the liquidity evaluation in chapters 23 on page 457 to 472. So what is liquidity? Liquidity, when we think about this as a definition, is the ability of a business to meet its short-term debts as they fall due. So can a business pay off and meet all their short-term debt obligations when they fall due? It's an incredibly important part of business, and if you don't manage this effectively, businesses go bankrupt. So what is liquidity? We need to understand for a trading business to survive, and it is as serious as that, you must have sufficient liquid funds available to meet the needs. So liquidity is talking about liquid funds to meet needs. What are these needs? These include the payment of expenses, the paying of invoices to your suppliers, meeting the GST settlement obligations to the government, and or your loan obligations to the bank, and potentially drawings going to the business owner, which might be mandatory if a business owner really needs that to survive. So you need to pay off these things when they're due. How do you pay off or meet these requirements? There's actually only one asset that can pay off these requirements. Debts are paid off with cash. So a business needs sufficient assets that it can turn into cash to meet its liabilities. This is a complicated part of evaluation because efficiency, and especially the efficiency ratios inventory turnover and accounts receivable turnover, are important. Efficiency is important to liquidity, and I'll talk about that later. Because remember, efficiency is all about how quickly you turn your purchases and sales into cash. And the only way to pay off your debts is cash. So if a business takes a long time to turn its inventory into sales, high inventory turnover, it's putting pressure on its cash, its liquid funds. Also, if a business has slow accounts receivable turnover, the business is going to have to wait a long time to collect cash, which is also going to impact its ability to pay its debts. And this is especially important because expenses in a business, your obligations, don't wait. Employees' wages, rent, just to name a few, it could also be electricity and telephone expenses. Everything really must be paid when it's due. Otherwise, you're going to have unhappy employees, landlords that won't let you stay there, and maybe even your electricity's cut off. So this is why it's so important to survival, and a business must manage it effectively. And how do we analyze this and look at the financial information to determine liquidity? We look at liquidity indicators, and we're going to look at three in particular. What ones are we going to look at in particular? This should say liquidity indicators. We're going to look at cash flow cover, working capital ratio, and quick asset ratio. These are the three that we use to analyze liquidity, but we also understand that the three efficiency indicators are relevant to liquidity as well. What do we need to know about these indicators? The same information that we need to know about all our indicators. Do we understand the following 6 things? The formula of the indicator, what the indicator analyzes, so what is this financial indicator telling us? All 3 liquidity indicators tell us something slightly different. Do we want this indicator to go up or down? And is this increase or decrease favourable or unfavourable? Indicators about liquidity also have a few benchmarks that could tell us whether it's good or bad. So do we have an indicator that is good or bad? And then if we know all this information, but then we start to do the analysis, what could have caused the change and what strategies could we do to improve? And that's what we need to do in our VCE Unit 4 accounting. And maybe more importantly, this is actually what accountants do. This is how we earn the big bucks. So let's have a look at our first indicator, working capital. You might have heard of it before. Working capital has actually two formulas. Working capital is a simple calculation, current assets divided by current liabilities. But we're going to focus more on the indicator that you'll be given, working capital ratio, which is current assets divided by current liabilities. What do both tell us, but especially the working capital ratio? Working capital is a dollar measure. It's going to tell us just the dollar amount that is the difference between our current assets and current liabilities. If we have more current assets, remembering this is accounts receivable, cash, inventory, prepaid expenses, we're going to be able to likely be able to meet our short-term debts. Our current assets, things that we're going to turn into cash within 12 months, are higher than our liabilities, our obligations. Now, this is just a dollar measure. What is a more effective indicator is working capital ratio. This allows us to compare businesses and examine the relationship. So rather than stating the working capital as a dollar value, the assets are divided by the current liabilities and gives us a ratio or percentage. This allows us to look at trends and analyze between different businesses. Working capital ratio is measured as a ratio of current assets to 1. So how much more current assets do we have to every $1 of current liabilities? And generally, and this is generally, and we'll look at this in a second, increases are favourable. So how do we analyse it? What is good or bad? Typically, we are looking for a working capital ratio that is more than 1 to 1. Because what does it mean if working capital is less than 1 to 1? This might mean the firm has difficulties in meeting its debts as they fall due. This is because they have current liabilities are higher than their current assets. So they might be required to do things, make capital contributions, seek additional finance, so more overdrafts or a loan. But also we might have to think about what would occur if the working capital is much greater than 1 to 1. This might mean we have too many current assets and we're not using them effectively. So typically what are we looking at? We're definitely looking for a working capital ratio that is more than 1 to 1 and with a bit of a buffer, maybe minimum 1 to 1.5 to 1. But we don't want one that's too big. Why could working capital increase? Generally favourable. We could be holding more inventory, slowing our collection of accounts receivable. So you might suddenly start to see a bit of a warning sign. Both of these might not actually be good things, but they're increasing our indicator or increasing cash. Decrease, so generally unfavourable, could be increasing our accounts payable, what we owe to suppliers, increasing our overdraft, so having negative cash, or just, apologies, I should say, decreased or deterioration in financial performance. So it shouldn't say improved, it should say deteriorated and bad sales. A deteriorated gross profit, that's my mistake. So how do we evaluate it? No matter how often working capital ratios are calculated, these will vary from business to business. And even though I've said you want it to be more than 1 to 1, I don't want you to think of this as a hard and fast rule. We need to actually look at the business and evaluate it. And here is 2 examples. Business 1 has a different set of scenario to business 2. In business 1, all purchases are on credit and all sales are made for cash. And inventory turnover is very fast. So if we think about this, this business has an incredibly quick cash cycle. It buys inventory, sells it really quickly and gets cash straight away, and it has the benefit of delaying its payments to suppliers. Business 2 is really different. All their purchases are for cash, all their sales are on credit, and inventory turnover is very slow. Their cash cycle is very high. They buy something, takes a long time to sell it. They don't get the cash straight away because it's on credit, but they pay their cash to their suppliers straight away. So, businesses can sometimes trade successfully with a low working capital ratio, while others require a higher percentage. We need to consider the cash cycle. Business 1 could trade significantly more successfully with a lower working capital ratio than business 2. Why is that? Because they're turning their sales into cash quicker. They're still going to have cash coming in on a pretty consistent, quick basis. But what might be some of the issues with working capital? Let's come to that in a second. Now let's think about, can working capital ever be too high? And the answer is probably yes. Business 1, if we look at a different business, how would we analyze a business that has a working capital ratio of 4.5 to 1? It has $4.50 of current assets to every $1 of current liabilities. Seems like the liquidity is pretty good. But a ratio of 4.5 to 1 may indicate that the percentage is much greater than that they require. This might not seem like a problem at first, but it can indicate issues. It could be that they've over-invested in current assets. They have too much money tied up in cash at bank, which doesn't get a return. Inventory, so maybe they have too much inventory, which is costing them money, or maybe going off. Or they have too much accounts receivable, and remember, accounts receivable having too much of it could be an issue. If they have excess cash, they should put it to use to expand their business. The business having too much inventory, as we said, is an issue. And as we talked about quickly, having too much accounts receivable could be an issue. Maybe they're getting a bit older, these accounts receivable. Maybe we actually have a few bad debts coming up that we don't recognize. So with all these issues, and the major issue being working capital doesn't recognize really liquid assets, let's look at a few other financial indicators. And the next one is quick asset ratio. This recognizes that some of the current assets in working capital ratio aren't actually going to be able to be turned into cash really quickly. So it has a different formula. Quick asset ratio does have current assets divided by current liabilities, but it removes inventory and prepaid expenses. So it's always going to be lower than working capital ratio. Why have we got a different indicator? Because this measures the ability to meet immediate debts. It compares cash at bank and accounts receivable, because these are really the only two other current assets left when you remove inventory and prepaid expenses, divided by current liabilities. What it's looking at is how much, looks at the assets that can be turned into cash urgently, quick assets, to meet debts in the near future, urgent debts. Why is this? Because cash can always be used to be paid debts, to pay off your debts, and there is an assumption that you can turn your accounts receivable into cash pretty quickly, hopefully within 30 days, for example, if your credit terms are 30 days. So it removes inventory and prepaid expenses because these cannot easily be converted into cash in a time of crisis. If you owe a lot of money in 5 days' time, it's going to be hard to turn that inventory into cash in time. And those prepaid expenses, So for example, the prepayment of rent for 6 months, your landlord isn't going to give you that money back. It's really money out the door. So quick asset ratio is again going to be a ratio of current assets to 1, and its increases are favourable. And we're going to look at a quick asset ratio, hopefully that has a minimum value of 1 to 1. That is your benchmark. But we're also going to look at trends, management expectations, and budget objectives. Why might it increase, which is favourable, reduced buying from accounts payable, increase credit sales, and increase cash. It could decrease by increase in credit purchases, decrease in accounts payable turnover, or if you're using cash to purchase non-current assets, so using a current asset to buy a non-current asset. So really what this is looking at how quick you're able to, what is the ability to meet the immediate debts. What we're looking at is an indicator that is looking at more liquid assets than your working capital ratio. But even some people say that is not appropriate, because even in a real issue, you're not going to be able to turn your accounts receivable into cash straight away. So we should just look at cash. And our third and final indicator is cash flow cover. Cash flow cover is the formula here. We're going to look at your net cash flows from operating activities. So just cash from your day-to-day business operations, and divide this by your average current liabilities. What is this telling us? It emphasizes cash, because we understand that profitable businesses go bust if they can't control their cash. So this is one that's just looking at, do you have enough cash from your operating activities to meet your average liabilities? This is measuring, as I said, how much cash generated by operating activities against short-term obligations. We measure it in a slightly different way, and I'll show an example in a second. We measure it in number of periods, but again, with both our other indicators, increases are generally favourable. So what does a cash flow cover of 10 times mean? This means that net operating cash flows equal 10 times what it is owed in current liabilities. If you have a cash flow cover of 10 times, you add 10 times the net operating cash flow compared to your current liabilities on the balance day. So how do we analyse it? Is 10 good? It sounds pretty good when you think about it there. But for a trading business on 30-day credit terms, 12 times would be seen as the minimal acceptable cash flow cover. This is because a year's cash flows can be expected to cover the accounts payable earning at the end of each given month. Otherwise, the business is not producing enough cash. Because remember, it's average current liabilities over the net cash flows. So each year, each month, we're going to have to keep paying off our liabilities to keep it at the average level. So we need 12 times. But again, we're going to look at trends, expectations, and budgets. Why will it go up? Increasing cash flow from operating activities and decreasing current liabilities. Or increased use of long-term debt. It could decrease, which is unfavourable, by increasing your current liabilities, decreasing your cash that you're making from operating activities, and that's cash flow cover. Really looking at how well is a business controlling its cash. How well is it able to pay off its debts with the cash from its day-to-day operations. So finally, when we're thinking about liquidity, we look at efficiency. We understand that liquidity is the ability of a business to meet its day-to-day debts as they fall due. And we understand that we now have 3 indicators: working capital ratio, cash flow cover, and quick ratio to analyse this. But we also understand that efficiency is how effectively we manage our assets and liabilities to turn our daily business into cash. So if we can effectively manage our efficiency indicators, accounts payable turnover, inventory turnover and accounts receivable turnover to get our cash cycle down, we're going to improve our liquidity as well. And guys, that is how we evaluate financial performance with liquidity. We look at 3 indicators to see if a business can pay off its short-term debts as they fall due with cash, with using 3 indicators: working capital ratio, quick asset ratio, cash flow cover, which all are a proxy for cash, but they all have their own special, unique limitations and advantages. How do you practice to get better at this? By doing exam questions. So let's have a quick look at 2 before we finish. The first one is a quick one. The exam question from 2019, question 1, part E. This was a business that was Max Games, and they were concerned about the liquidity of the business. So you're seeing the word liquidity. The question was, and they were given 3 indicators: inventory turnover, so an efficiency one, and we understand this is linked to liquidity, and also working capital ratio and quick asset ratio. And the business wants to understand why working capital ratio is declining, but quick asset ratio is not. So let's have a think about this. Why could quick asset ratio be flat? You can see it's flat. And working capital ratio has gone down significantly from 1.5 to 0.8. Why could this be the case? What's the difference between the two ratios? Remember, working capital ratio must include inventory. So maybe this has gone down because inventory has decreased, but quick asset ratio has not. Quick asset ratio does not include inventory. So you could provide an explanation to say inventory has decreased, which would reduce working capital ratio, not impact quick asset ratio. This could be because of just buying less inventory or an inventory write-down, or this could be due to something to do with prepaid expenses decreasing, which would impact your quick asset ratio, working capital ratio, but not quick asset ratio. The next question we'll look at is question 3 from that exam. So you can see how important liquidity was in 2019 to the examiners. They had 2 exam questions related to it. This question related to the business called Going 321, which again had concerns about liquidity. Here we've been given the budgeted cash flow cover, which has gone from 7 times to 4 times, all the way down to 0.6 times. A significant downward trend, which we know is negative. So what is the effect of this on the liquidity? They have less cash, in fact, insufficient cash from operating activities to meet their operating activities. What could be the reason for this? Really, there's 2. Their current liabilities could be going up, or their cash flow from operating activities could be down. How do cash flow activities from operating activities go down? Largely because sales maybe are going down, and particular cash sales could be going down. So what are the strategies that you could be doing? It might be all about, explain a strategy. What could be strategies that could increase your cash sales would be an appropriate answer. And with that, we end. I hope this has helped you along with the other videos in evaluating financial performance, and particularly this one in evaluating liquidity. Now's the time to really practice exam-style questions to become an expert.